So I'm Ido. I'm in Latif's team, the research team, and I will make a hopefully short talk about a topic which is called decentralized insurance. So just to say at the beginning, I'm not an insurance expert, so if you feel free to correct me or add anything that you know. And also, if you have questions, feel free to ask in the middle of the talk. And first thing I will start before talking about decentralized insurance is what is insurance generally from first principles. So we'll start with an example, and it will be a very basic example. Let's say we talk about home insurance. And we have a person called Alice, and Alice owns a house which is worth $100,000. Okay, and let's say Alice wants to insure herself against disastrous damage to her house. Let's say from earthquakes, fires, things like that. And also, let's assume that the probability for a disaster like this is 0.1% annually per year. Which means you have an event like this once in 1,000 years in expected value. Okay, so what Alice can do? So first, let's consider a pre-insurance world. What does it mean? You don't have the concept of insurance. Alice wants to insure herself against $100,000 damage, so she has to have $100,000 liquid in her bank or under the pillow or somewhere. So if she doesn't have it, she will take a loan, and she will pay the principal rate and also the interest rate. Taking a loan is costly. And not only Alice, everyone that wants to insure themselves against such a risk will have to take a loan. And as a note, from the perspective of economic perspective, this is also a very inefficient use of money. Lots of unused liquidity of capital. Okay, so we invented
I'm not sure why would you take a loan?
Okay, so you have a house and you want to insure yourself against the disaster. Something happens to the house. So you want to be sure that if something happens to the house, then you will be able to buy a new house, which also, let's say, costs $100,000. So in a pre-insurance world, you have to have $100,000 under the pillow to be insured against this event. Okay. So we invented the concept of insurance. And what is the basic notion here? The basic notion is collective solidarity. It says, let's share the risks. What does it mean? Each of one has a small risk that such an event will happen. In our example, it's 0.1%. It means the expected value of it is once in 1,000 years. If you take the expected cost from such a risk, you will multiply $100,000, multiply 0.1%, and you will get $100. This is the price that you will expect to pay annually for this risk. So why don't we come together and each of us will pay this expected loss, $100, and we'll make a shared pool, which purpose will be to insure us, the whole group, against such disasters. The ones that will such an event will strike them, they will get compensated, and it should support us all. So to take a concrete example, assume 100,000 homeowners come together everyone contributes $100 annually to this shared pool, and we have a pool of $10 million. And from the law of large numbers, from probability theory, we have that with high probability, we'll have close to 100 homes damaged in a year. And how do we get it? It's just 0.1% out of 100,000 people. It's 100 people that this event happens to them. And that's exactly 100 people that this event happens to them, multiply $100,000 is exactly $10 million. So in the expected value, everyone is covered. Like each year everybody puts $100, and each year we have with a high probability that the amount of people that this will happen to them is 100, and everyone gets and the insurance pays for all the events.
But you know, if a disaster happens, then everybody is being pulled down altogether. It's not like every 1,000 years. In the year that it happened, then everyone is doomed. No.
Okay, you caught me. Let's say we will assume insurance is more complicated. Here we actually assume that the events are uncorrelated, independent of each other. Maybe in the case of independent of each other, it means that the probability of my house to get ruined, the probability is independent of your house, of the probability of your house to get ruined. The real world is more complicated because you have it depends on the events, but you have things that there is correlation between events. Okay, let's say it's an insurance of against a fire in your house that was caused from you lighting it up. So that's pretty much independent. Okay. So what happened is we shared the expected value of the damage from the risk. Okay. Any questions? I'll continue. So if we talk about the types of costs that you have in a typical insurance, there are three main costs that are transferred to the insured as the price of the insurance. This is the expected value of risk. In the above example, it was the 0.1% of an event happening, but you also have long tail risks. What is long tail risks? This is you want to also be insured against more rare events. What does it mean? If we said that with a high probability about 100 houses will be damaged, but still you have a probability that for some reason in some year 500 houses will be damaged. So if everyone will pay only $100, there will not be a sufficient amount of funds in the pool. So when we get insured, we also want to be insured against more rare events. This is the long tail risks. The name comes from the long tail of the probability density function. Okay, so and the third one is called transaction costs. It comes from the coordination problem. In the example above, I said that somehow 100,000 people come together and share a pool and they manage the pool and all of this, but it's actually not trivial. This is a big coordination problem, and today it is solved by insurance companies and they make this coordination for us. They coordinate all the individual funds, and all this system has costs, which also it's transferred to the cost of your insurance. Okay, so this is main three types of costs that you have in an insurance. So let's talk about the characteristics of the insurance. So traditionally, insurance was more of a community thing. The community came together and insured the members of the community. You had like the leaders of the community. If something happens to someone, he comes to the leader. The leader says, "Yeah, we'll pay you back." You see this today, mainly I think in religious groups. You know, in religious, let's say Jewish communities. When something happens to someone, he goes to the rabbi of his synagogue, and then the rabbi says, family of something, they need help, and they gather money from the community. Or I don't know, maybe kibbutz is an example. That was traditionally the insurance model. It surrounded the community. But this model has problems, and these problems are of efficiency. Insurance models benefit from scale, and this is primarily due to the underlying economics of insurance. Basically, a diversity of risks, and when there are a lot of insured people, it allows the product providers to provide better products, better policies to the people being insured. And so what happened, we moved away from the community approach, and we entered the model which we all know today. Insurance is managed by insurance companies, big insurance companies, which provide us this basic need of insurance, which is great, but has some new challenges in this model. And the main two challenges are incentives. So today, the insurer is a profit-seeking agent. It is not, in contrast to a community-based model, which acts entirely for the benefits of the members. And so interests and incentives are not directly aligned between the institution and the individual. And the second one, big second one, is information asymmetry. What does it mean? These institutions thrive on data collection. When they have more data, they can provide better products because they can analyze the data, and they create silos of data vaults, which decreases the capability to have a competitive market. That's why it's very hard to enter this realm of insurance. And it is a problem you see in many spheres in our life. We are not the owners of our data. Okay, and these challenges, the incentives problem and the information asymmetry, is mainly managed by the following solution, which is regulation, heavy oversight from government institutions, and complex legal frameworks. It is a very highly regulated sphere, the insurance ecosystem. Okay, so that was all about what is insurance and the basic characteristics of insurance. Some questions? Okay, so we say today we can do better. Why? First of all, the idea of decentralized insurance was really present from the early days of the crypto ecosystem. From the rise of Ethereum, it was talked about as one of the killer apps that the ecosystem can provide. And the main thing is that with crypto networks, which are powered by blockchain technology and smart contracts, trust can be moved from institutions and regulations to transparent code and protocols. This is the underlying principle. And it can do a lot of things. If we talk about cost, then first it can strip out many inefficiencies in the system today, frequency inefficiency. This is the transaction cost that we talked earlier, that we have in our system today, which comes from all the regulation and all the frequency in the system. Secondly, it can restore the membership notion, something that is more closer to the community-based model that we had earlier, but we said it was inefficient, it was not scalable. And also, as part of that, align the incentives back to serve the people that are being insured. And basically, the main point, it allows the cooperative spirit to be regained in a cost-effective and scalable way. Okay. So, so that this is this was okay. Let's. Any questions?
You're doing a great job, Ido.
Okay. So if we like this idea of decentralized insurance, and we want to think about how do you design such a system, you have to break down the different components of insurance. What components make up insurance system? So this is part of the components, okay, the main components. The first one, let's call it the product. What is the insurance about? What is the product that is being served? Okay. Insurance for what? Okay. Okay, the second one is the pricing. We are used to the pricing being a function that the insurance company provides for us. They tell you, they ask you some questions, gather data about you, and they give you the price. How? The main thing that they do is they do the risk assessment. They analyze the risk regarding the policy that you are asking for. So if you have to have this functionality, and the question is how do you do it in a more decentralized way? How do you get risk assessment for let's say home insurance in a more decentralized way? And the pricing is just a function of the risk. Okay. Claims assessment, there is an interesting point here. Claim assessment is basically the notion that when someone has a insurance policy, and now he wants to, I don't know how to say it, sue the policy, the insurer, because some event happened to him and he wants a payback. Then today, what we are used to, you contact the insurance company, they tell you what to supply to them, what material to supply to them, and they have their expert which assess your claim and decide to pay you or not. Also, so here also the question is how do you do it in a more decentralized way, where all the power is not lying in a single place. And this is also relates to things that you have today. We need to separate between two types of insurance. There is the subjective insurance, which is what we are used to, is the regular insurance, where you basically insure against a predefined loss. You get a policy for your house which costs $100,000, and when you submit a claim, you tell how much damage was done to you. And a second type of insurance, which is more new and very interesting, it's called parametric insurance. What does it mean? So it's a non-traditional insurance product which offers pre-specified payouts based upon a trigger event. It is mainly used for for agriculture insurance today. What does it mean? It means that the one that is being insured, let's say some how do you say it, farmer, some farmer, he wants to insure himself against I don't know, bad crop. So so the insurance company create a function which is a proxy to the damage of the farmer. Let's say the parameter, and it has some parameters. Let's say the parameter is the amount of rain that was in the season, and the insured and the insurer agree about this function, and the function receives the amount of rain that fell in this area, and based on this parameter, it computes estimate of the damage to the farmer. And there is no claim assessment process here as in the previous model, in the subjective model. You get the weather data, you compute the function, and I'll get the payout that the function generates, and we agree upon this function. Okay, you understand what is parametric insurance? Okay.
Ido, does that eliminate the professionality that needs to be, well, to assess the insurance cost and pricing?
No, because the design of such a function, to design such a function, it's hard to design such function. You have to have experts to design it such that it will be a good proxy to your damage. If you try to...
In any case, you need a professional or an expert person, even in parametric insurance.
Yeah, of course.
How do you deal with this fact in the decentralized insurance then?
We'll talk about it.
Okay, all right. I'm excited about it.
We'll try to talk about it. But remember, decentralized, it's a blanket word. You ask the same way as you will ask 10 people what is a DAO, you'll get 10 answers. Decentralized insurance is also yet to be defined thing, and is also a spectrum. Yeah. So okay, let's talk about it maybe later. Capital model. Each insurance company has some capital model which tells, for example, based on the total pool of money that the insurance currently holds, how many policies it can sell. Okay, so you have to compute that somehow. And membership. We talked earlier that we can restore the idea of membership in the insurance. So that's also a thing. And if you have membership, your membership basically means governance also in the system. Okay. So maybe the best thing to do is just to look at examples from the industry today. So I will talk about the two primary players in the decentralized insurance world. And also, interestingly, they are very different. They took very different approaches for their solutions. So the first one is GIF by Iteris. GIF is generic insurance framework. And as the name implies, it is a framework in which insurance products can live, okay? And we'll have to talk about the different components that this framework has. First of all, Iteris currently are focused on parametric insurance use cases. Okay, for example, they really target hard the use case of crop insurance in third world countries, for example, in Africa. So what components do you have in this in the framework? So what they did, they said, okay, let's try to think about the flow of insurance in the most generic way, such that we'll design a system that would allow various insurance products to live in our framework. And they came up with some structure. So basically, in a high level, what do you have in this structure? You have a notion of product owners. Product owners, companies that, okay, first of all of this is built on smart contracts, on Ethereum, on the open source code, okay? So, and it allows the various components. The first component is the product owner. The product owner can offer insurance products. It can be companies or anything like that. And we said that the products that they focus now is parametric insurance. So I don't know, maybe not all of you heard about the term Oracle. You know what is Oracle? In the blockchain world? Okay.
Please explain.
Okay, so basically we told that in parametric insurance, we have some function that receives some parameters, let's say the amount of rain, and it computes the payout for each individual that is insured. So if we talk about a system that lives on-chain on smart contracts, somehow this data, this amount of rain has to go on-chain. Someone needs to provide this data. This is what is coined as Oracle. It is an entity that provides. And when we talk about Oracle, it usually means objective data to on-chain, to the blockchain, to some smart contracts. Okay, it's like the weather data. Okay, so you have various Oracle networks today that are running and working. Mainly today, they provide some economic data like rate values, exchange rate values between, for example, Ether and dollar. Okay, so you have.
It actually computes a value that is being given to the code, to the.
You have some smart contract which needs to get the weather data. So you, Neama, can be an Oracle. You say, okay, I will send you every 5 minutes transaction to the blockchain with the current amount of rain. And you're an Oracle. And the question that we put aside is, how do you do it in a decentralized way, in which you can't game the system, okay? Okay, so we have product owners, and we said that these products are parametric insurance products, so they have to have oracles. So you have also a marketplace for oracles, where different Oracle service providers can offer their services, and a product can sign up to an oracle. And also you have a risk pool keeper. What is a risk pool keeper? Each insurance product has its own pool of funds, pool of money, that if you buy an insurance and you pay a premium, this money goes to the shared pool. So you have a function of risk pool keeper, and you have the insured that can choose a product owner, and we have choose a product owner and buy a product, and you have an investor that also provides some capital to the pool of funds, and I think that's enough about GIF. And basically the point is, it's like an insurance marketplace built on open source code, on Ethereum, smart contracts, and all of this. Okay, But maybe the thing to point out, every product owner, he offers his products. He calculates the risk for the policies that he offers and the price for them. And he also does the claim assessment. Sorry, no, it's not true. The claim assessment here is he gives the function, the parametric, the function for the parametric insurance. Basically, he designs the product. Okay, some questions? Okay, the second one took a very different approach. It's called Nexus Mutual. And if we talk about the use case for the beginning, they provide this Nexus Mutual provides insurance against DeFi protocols, things from the crypto ecosystem. It provides insurance against for people who invest in DeFi, for people who use centralized exchanges, things like that. And the interesting thing is that Nexus Mutual is a DAO. It has a legal wrapper around it. It operates as something called discretionary mutual in the UK. And anyone can join and be a member of this DAO. And the special thing is that it is a DAO which provides products to its members and also all the necessary functionalities to have decentralized insurance are in-house in the DAO. For example, if you are a member of the DAO, you can buy cover for insurance for different DeFi protocols that you use, but you can also act as a risk assessor, okay? To somehow be take a part in the calculation of the risk of every type of insurance. And you also can be a claim assessor. Someone says, I lost money in this DeFi protocol. So people inside of the DAO, they are the assessors of your claim. And also participate in the DAO's governance. This is a DAO, and it is a living entity. It changes itself regularly by proposals. For example, to add different products, to change some parameters in some functions in the DAO contracts, things like that. So tell me if I'm out of time, okay? Any questions?
Just to say, it's 5:15, just so we.
And I need to end when?
We are finishing at 5:30, but maybe
okay.
10 minutes before.
Yeah.
I just want to know if the Nexus Mutual works. Like, are people being insured through this vehicle?
Yeah. So interestingly, Nexus Mutual is pretty huge. It's the biggest decentralized insurance in all measures, I think. I opened here actually some statistics about it. So the active cover amount right now is $630 million, which means that this is the amount that is being cover now. So that people insured against. And you have a lot of statistics here, but yeah, it's a big project, and it's the biggest.
Like always in blockchain projects, beautiful UX, amazing UI.
Yeah.
Classy.
Yeah, classic.
Yeah, here you see all the different protocols that the Nexus Mutual provides cover against. These are all names of DeFi services or exchanges, and you see the amount that being covered in millions. And I don't know.
What is the event of the insurance event in such an insurance? The company, the DeFi company, the DeFi is closed or?
So yeah, you regularly, I think, hear about a big hack there, which someone stole the money of a lot of people. So things like that. Or if you use a centralized exchange, for example, you use Binance, and Binance controls it's a custodian, it controls your crypto, your tokens, and for some reason it doesn't give you back. So you can get insured against that. Okay, and I said these two.
So it's mostly cover like crypto issues.
Yeah.
Okay, you can do something for your house, like to insure your house with this.
No.
With Nexus?
They for now their use cases are targeted at DeFi and custodian.
Pretty genius. They found like a niche that doesn't have anyone like covering it, and yeah.
Yeah, and they also done it in the spirit of the ecosystem by a DAO, which does it.
Incredible.
Yeah.
So and these are the only two, and the GIF works?
Yeah, okay. So we talked about the current state of the Nexus Mutual GIF. They first of all, it doesn't alive yet. It's still built. Maybe it's also already built, but it's not alive yet. Mm-hmm. And if you look at their activity, from what I looked, because of their approach, because they trying to they are going to like real world use cases, and they also go to the I think hardest real world use cases. They approach a community, people that are like maybe the farthest from all this world of from crypto. For example, farmers in Africa. A lot of their activity, if you look at it, is partnerships and demos in all these places, and they need to partner with local companies in Africa, and they need to partner with Oracle providers. So this is a lot of their work from what I see.
What's the business logic to go there? Why did they go to something that have little chance?
I think you'll be surprised about the usage of crypto in Africa in respect to other places in the world. Like, there's more use, actually. I think I saw lately some distribution of countries that use crypto. The thing is, I think it's about regulations and about availability of bank accounts and stuff like that.
So what you say is that actually they go there because they want to go around the regulations in a way.
Also they have customers there.
Yeah, but I mean, they don't want to count on like the government or the normal regulation.
Well, they have to. They have to do it. For example, when you target an audience like farmers in Africa, you can't pay them with. They can't get paid in Ether. They have to. They have to somehow convert it to their local currency. So that is also a problem. You need to stitch all the different difficulties. It's not like working in the crypto ecosystem where all your customers are also native in this ecosystem.
So I'm really not sure about it. I know for a fact in Ecuador, for example, like the government has approved the use of Bitcoin as like a normal means of commerce. I'm really not sure about it.
So Africa is big,
but so we're a little sidetracking and we don't have that much time. So I think maybe let's.
Yeah. Okay.
Mm-hmm.
That's fascinating, though. If I want to buy this insurance, where I need to go to buy to?
Gael, that's like a really serious detour. That is for further research with Ido.
Okay, so we started to touch about the key differences between them, it comes out when you look at every parameter. So one is a framework which is being built by a company, Iterisk. The other one is a products which are serviced by a DAO. And if you look at the pricing, so in the framework, each product owner in GIF, each product owner decides the pricing, but in the DAO, it's done in a decentralized way by a mechanism which is a prediction market. Basically, people stake their money against the risks of different DeFi products. What it means is you say, okay, I think this DeFi protocol is very, very safe. I put my money on it. If if some hack happens to this DeFi protocol, take my money, I will cover you. But if not, I will get some interest from the money that I put. This is a prediction that market type of thing. And the risk is calculated as a function of these stakes. And claim assessment, so in GIF, each product owner.
How did they calculate the earnings though? It's also...
What do you mean earnings? What do you mean earnings?
Like you said that if I risk my money, I want to get some interest. So how did they calculate the interest in this case?
They predefined a formula of how depends on the amount of stake that you put, how much, how big of a percent of the premiums people pay you'll get, and things like that.
And it's all like for everyone, the same interest.
No, it depends on the amount of stake that you put.
Interesting.
I think, yeah, but you need to explain staking. So maybe that's for like staking is a whole thing that needs to be explained.
Yeah. Okay, so claims assessment, as in GIF, each product owner, he assesses the claims, but in the Nexus Mutual, again, it's players in the DAO, it's DAO members which sign up as claim assessors. What they get from it, they earn some money from being claim assessors, and they look at claims of people and they assess them, basically say, yes, he should receive money or no. And you have a whole game around it that's to disincentivize bad behavior, yeah, like a crypto economic game. And also, as a side point, you have also what is called the advisory board in the Nexus Mutual, which are like the people that started, I think, the whole thing, and they have like a special oversight thing, power, but they can be replaced by the proposal by proposals. Like people can say, I don't like him, and if the DAO agrees, that then he will be out of the advisory board. Okay, so it was the claim assessment. The token role is also very different. I think that less relevant, more like economic things, and also the token price. Use cases, we talked about it, and current state, we also talked about it. All is very different between both of them. And to wrap it up, why we talk about that is why we started looking at this world of decentralized insurance is because we have like maybe a cooperation with some big insurance company and that wants to enter this world and wants to maybe cooperate with the DAO stack and get help in designing the system. So that's why we're looking at it now. And that's it.
Wow. Ido, thank you. That was really thorough and really, really interesting. Yeah, questions, guys?
No, I think we should you should like store this recording of this session, and like for other people in the company that want like just to know about this project, so we doesn't have to do it again. Just put it somewhere that is accessible.
Guy will forward it to you, and you'll do it.
I'll do it.
Great.
I offer myself. I'll do it. Just pass me the recording, and I'll put it.
Will do.
Okay, and now wait, before we say bye, everyone open your cameras for just a second so I can take a picture of all of the people that were here for an hour and a half and listened to all this important knowledge here. Ro'i, is it possible to see your lovely face? Yes. Okay, smile. Bye, everyone. Thank you so much for being here. You were great. Thank you, Ido.
Thank you, Ido.
Thank you, Yoni.
Oh, thank you.
Bye-bye.
Guys, everybody,
Thank
the
you,
next
Arava.
talk will start in
Thank you.
5:45.
Bye, everyone.
Bye-bye.
Bye.